Hello friends, Shashi Agarwal Economics and Law classes welcome you all. Today our topic is marginal efficiency of capital. We are going to understand the meaning of marginal efficiency of capital, determinant of the marginal efficiency of capital, that is the prospective yield and the supply price. And we are also going to understand marginal efficiency capital in the form of rate of discount and the factors which affect the marginal efficiency of capital. If you find my video useful, please do like it, share it, and also subscribe my channel Shashi Agarwal Economics and Law Classes. So this is my app, Edusam app, which you could download from Google Play Store. It provides free study material and free mock test, subjective test, and test in the form of MCQ to the student of economics, commerce, and management. It also provides very structured courses, commerce, economics, and management. In economics, macroeconomics, microeconomics, principles of economics, business economics, managerial economics, business economics, Indian economy, and public finance and development economics, they are available as structured courses. So first of all, we will understand why do we make investment. When we make investment, it depends upon two things: marginal efficiency of capital, that is the expected profitability, and the second is the rate of interest. And the rate of interest is the cost of obtaining the funds, that is the cost of borrowed funds. So we compare marginal efficiency of capital with the rate of interest. If the marginal efficiency of capital is more than the rate of interest, then we go for the investment. In the short period, rate of interest is constant. So investment is mainly influenced by the marginal efficiency of capital. So Irving Fisher in 1930, first economist who coined the term marginal efficiency of capital. He called rate of return over the cost. So whenever we talk about marginal efficiency of capital, it means expected rate of profitability of new investment. And the efficiency means rate of income. Marginal efficiency of capital means income received after deducting the cost from the return of additional unit of capital. When we invest in the additional unit of capital, how much income we receive, then how much cost we incur. From that income, we deduct the cost. So, marginal efficiency of capital is the net profitability. Marginal efficiency of capital depends upon two things: the amount of expected profit and the cost of capital asset. The price of the machine is 50,000. The age of the machine is 10 years. So revenue during 10 years is 70,000. So net profit is 70,000 minus 50,000. That comes around 20,000. Profit per year 20,000 divided by 10, it comes around 2,000 per year. 2,000 divided by 50,000 into 100, it comes around 4%. The definition of the marginal efficiency of capital. Marginal efficiency of a particular type of a capital asset is the highest rate of return over cost expected from an additional or marginal unit of that type of asset. Marginal efficiency of capital means the expected rate of profitability. According to Peterson, the rate of return over cost relates the expected yield of capital goods to its supply price. This the relationship is called, uh, according to Keynes, the relationship between the prospective yield and the supply price is known as marginal efficiency of capital. Kurihara has defined marginal efficiency of capital is the ratio between the prospective yield of additional capital good and their supply price. So the determinants are the prospective yield and the supply price. Now we will understand it one by one. The prospective yield is the when we invest in capital asset, it generates a revenue to us. Here the prospective yield is the net revenue. It means income minus cost. So it is the net revenue. So Q1 is the net revenue, net return in the first year. Q2 is the net return in the second year. Q3 is the net return in third year, and so on. So by totaling it, we will get the prospective yield. If there is a change in the market price, so the prospective yield will also change. Supply price of capital asset is the cost of producing a new asset of that kind. If today we want to change that asset, then the price which we pay or the cost of producing that similar asset is known as a supply price. Does not mean the supply price of an existing asset. Supply price of a capital asset is also called the replacement cost, and it remains fixed in the short duration. Formula for calculating marginal efficiency of capital. A capital asset is used more than one. So its total yield is the aggregate of the annual prospective yield throughout its life period. If the asset has 5 years, then the first year the prospective yield, in the second year, then the third year, then the fourth year, then the fifth. We add 5 years, 5 years annual yield, then we will have the total yield. Prospective yield can also be found like a compound interest from the principal amount, that is the supply price of the capital asset and the marginal efficiency of capital. So here of the first year, because we are investing in the asset, so supply price is the principal amount. So into 1 plus M. M is the marginal efficiency of capital. And we could also write in this form. Supply price is equal to prospective yield of first year divided by 1 plus M. In the second year, P1 becomes the principal amount. So PV2 we calculate PY1 into 1 plus M. And PY1 is equal to supply price into 1 plus M. So we substitute the value of P1 in this equation. So we will have supply price into 1 plus M square. In the same manner in the third year, because here in the third year, PY2 into 1 plus M. PY3 becomes the principal and PY2 becomes the principal amount, and PY2 we know that is equal to supply price into 1 plus M square. So we will have the formula in this manner. Supply price into 1 plus M to the power 3 cube. The aggregate or net return expected by the use of capital asset will be called prospective yield. Total lifespan of a capital asset is n year. From the aggregate of the prospective yield, then the supply price can be calculated in this manner. Py1 divided by 1 plus M, Py2 divided by 1 plus M square 2, raised to power 2 into Py1 divided by 1 plus M raised to power N. Or we could write in this manner, supply price is equal to prospective yield of nth year divided by 1 plus M and raised to power N. Or we could call it 1 plus M raised to power N into SP, which is equal to prospective yield. Or we could also simplify it 1 plus M Py divided by prospective yield divided by supply price nth square root. So M we could calculate in this manner, nth root of prospective yield divided by supply price minus 1. If we have prospective yield and supply price, then we could calculate the value of the marginal efficiency of capital. So here, if we take the marginal efficiency of capital in the form of rate of discount. Rate of discount is that value which equates the future of capital value with its present value. So Lord Keynes has explained marginal efficiency of capital in terms of that discount rate, which makes the prospective yield of capital asset equal to its supply price. So supply price is equal to prospective yield divided by 1 plus M, prospective yield of second year divided by 1 plus M raised to power 2, and nth year, the prospective yield of nth year divided by 1 plus M raised to power N. M is the discount factor, that's the marginal efficiency of capital. So which equates the value of the prospective yield to the supply price. Marginal efficiency of capital in general. There is a difference in marginal efficiency of a particular capital asset and marginal efficiency of capital in general. When we talk about the marginal efficiency of a particular capital asset, it means the rate of prospective yield which is obtained by investing in new or additional unit of capital asset. But when we talk about in general, because when we want to invest, there are so many options. Definitely, we select that option which gives us the maximum profit, maximum return. So, marginal efficiency of capital in general means refer to the highest rate of prospective yield of a new unit of a capital asset. The marginal efficiency of capital in general is the highest rate of return over cost expected from producing an additional or marginal unit of the most profitable of all type of capital assets. So when we talk about the marginal efficiency of capital in general, it refers to the highest marginal efficiency of the most profitable of capital asset. So here we see as we go on increasing the investment, the marginal efficiency of capital goes on falling. When we invest 50 crore, then the marginal efficiency of capital is 12%. When we go on increasing the when we go on increasing the investment, the marginal efficiency of capital goes on decreasing. It is subject to diminishing marginal rate of productivity. So we could draw the curve. On OX, we take the investment. On Y axis, we take the marginal efficiency and the rate of interest. Here we see if the at this rate of return, the investment is OM. But when the investment raises to OM1, then the rate of profitability declines to from R to R1. And investment, so this is the marginal efficiency curve, which slopes downward from left to right. So what are the causes of marginal efficiency to decline? If there is a reduction in selling price, it means when we make more investment, so there will be more production, more supply. With the supply more, so there will be reduction in the prices, and so the prospective yield will also reduce. In the similar manner, if there is an increase in the investment in the production of particular type of capital asset, it will raise the demand for a particular type of capital asset and the also the other factors of production. So the supply price, higher the supply price, lower the marginal efficiency of capital. Every when we with the making of more investment with the use of every additional unit that is followed by diminishing physical productivity. So it is subject to more investment, it's subject to more diminishing productivity. Prospective yield and marginal efficiency of capital fall despite of price remaining the constant. Marginal efficiency of capital and rate of interest. According to the classical economists, it is the rate of interest which is the main determinant of the investment. But according to Keynes, investment, they are more related to marginal efficiency of capital. Investment is governed by the marginal efficiency and rate of interest. So marginal efficiency of capital, that is the expected profitability, and the rate of interest is the cost of getting the funds. So while investment, we compare marginal efficiency of capital with the rate of interest. If the marginal efficiency of capital is more than the rate of interest, then we go for the investment. If the marginal efficiency of capital is less than the rate of interest, then we don't go. So here, this is the supply price. This is the annual yield. So 200 divided by 500 into 100, that is the marginal efficiency of capital, 4%. 200 divided by 4,000 into 100. So this is the 5%. And again 5,000 is the supply price and 200 is the annual yield. And the marginal efficiency of capital is 4%. So rate of interest is, if the rate of interest is 4% here, they are both equal. We could go for the investment and we could not go for the investment. So the investor is neutral. But if the marginal efficiency is more than the rate of interest, so definitely we are going to make the investment. But if our marginal efficiency of capital is less than the rate of interest, then we are not going to make the investment. Effect of change in the rate of interest on investment also depends upon the elasticity of marginal efficiency of capital. If marginal efficiency of capital is more elastic, then there is a slight fall of rate of interest, but there will be more change in the investment. But if the marginal efficiency of curve is less elastic, there will be heavy reduction in the rate of interest, but that will be producing little increase in the investments. So we will call it less elastic. Case of more elastic, as we see, the rate of interest has fallen from R to R1 this much, but there is an increase in more investment. The change in investment is more than the change in rate of interest. So it is more elastic. In the similar manner, if the change is more in the rate of interest, but there is a change in less in investment, then then it is less elastic. Here we see the rate of interest has fallen from R to R1. This change is more than the change in. So investment is increased only M to M1, and this change is less than the rate of interest. So it is less elastic. Investor invest up to a limit where marginal efficiency of capital and rate of interest becomes equal. Because he always compare marginal efficiency to the rate of interest, where he stops, where they becomes equal. Marginal efficiency of capital is expressed in terms of the percentage per annum. And he consider both marginal efficiency of capital and rate of interest simultaneously. And here we draw the investment demand curve, which shows the different amount of investment and different levels of the equality between the rate of interest and marginal efficiency of capital. Here we see as the rate of interest goes on falling from 10 to 8%, so the level of investment goes on increasing. So this shows the inverse relation between the investment and the rate of interest. At high rate of interest, we will be investing less. At the low rate of interest, we will be investing more. Investment demand curve slopes downward from left to right. Low rate of interest investment will be more. High rate of interest investment will be less. There is inverse relationship between the investment and the rate of interest.